Welcome to Volatility Trading Strategies. So recently I introduced my freestyle trading strategy called VTS Discretionary. I'll leave a link for that video so you can check that out later if you haven't seen it. This strategy makes up 10% of our total portfolio solution, and I'll make it as varied as possible. I'll cover everything from long and short stocks to more complicated option spreads and some sequence type trades. Now, some people like to sell these as programs or online courses, but I just want to give as much value as I can totally free, so expect more of these videos. For anyone who does want to see the actual trade executions, you can poke around my website, but today I'm going to introduce one of those trade sequences, and I call it the Wheel of Fun. Let me show you why. So this Wheel of Fun sequence is one that I've been trading in my own portfolio for over a decade now. It's fairly simple in structure, and hopefully if I do my job well today, it's fairly easy to understand as well, and it can be effective in most market environments. We can apply this when stocks are undervalued, we can use it when we feel the markets have gotten a little ahead of themselves, and with good trade selection, it can also work in that middle ground as well, so it's very versatile. But one thing I want to make clear here is that this is not a strategy that you want to get overly aggressive with and chase outsized returns. That'll just get you into trouble. Now, the truth is, most strategies that people get too aggressive with will get them into trouble eventually. But this strategy, by very design, is quite conservative, so it matches up well with my personality. I'm a patient, long-term investor, and I don't ever like to chase big gains. So this Wheel of Fun strategy is perfect for me, and I hope you like it. So this strategy can be done with both puts or calls depending on the overall valuation of the market. Right now, I'll demonstrate the put side sequence. We start by selling a cash-secured put, and we do this on stocks that we would be comfortable holding the shares on anyway. It'll be cash secured because we always make sure we have the capital to cover the position if we get assigned the underlying shares. So for example, if we have $10,000 for the trade, we're not going to just sell $10,000 worth of put options. That would be a very leveraged position. Instead, we're going to sell the number of options that correspond to roughly $10,000 of what the underlying stock would be valued at if we did hold the shares. That's what makes it cash secured. And typically we'll be looking at 1 month time frame, so monthly options only. After selling the initial cash-secured put, 1 month later there are two possible outcomes. The first is the option expires in the money. In that case, we keep the premium we sold and bank a little bit of profit, and then we get assigned the underlying shares, so we're now long the stock at a better price than had we just bought it outright. Remember, we liked the stock in the first place, so essentially we get paid to do what we would have done anyway, and we get the shares at a discount. The second possibility is that it expires out of the money. In this case, again, we keep the premium we sold, that's ours no matter what. And since the option expired out of the money, nothing happens and we find ourselves in cash again. So we'll just go back to step 1 and sell another cash-secured put. This cycle can be repeated until we actually get one that expires in the money and we get assigned some shares. Once we do have a trade that gets assigned, now we turn around and sell a covered call on those shares. Again, we're perfectly comfortable selling the stock, so we might as well get paid a premium to do that as well. Now, when you own shares and sell a covered call, again, there's two possible outcomes. The first is it expires in the money and we lose the shares. In that event, we keep the premium we sold and bank some more profit, and now we find ourselves in cash again at the end of the sequence. The second possibility is that it expires out of the money and we keep our shares. We still keep the premium for the covered call, and then just sell another covered call for the next month. This step will be repeated until we eventually get rid of the shares and reach the end of the sequence. Hopefully now you can see why I call this the Wheel of Fun. It is a sequence with binary outcomes, but if you look at it another way, you can see the wheel. Again, starting with the put side. Step 1, sell a cash-secured put. Step 2, keep doing this until we get assigned the shares at a discount. When we get some shares, step 3, sell the covered call. Keep selling covered calls until step 4, we lose the shares and we're back in cash. Then back to step 1 and rinse repeat. This is the Wheel of Fun. So in the ideal situation, we'd sell a cash-secured put now for 1 month out into the future and collect some premium for doing that. Then 1 month later, we'd get assigned the shares and immediately sell a covered call collecting more premium. And then 1 month after that, we would lose the shares and we'd be back in cash. So the perfect life cycle for this trade is 2 months. But this is investing and things aren't always that clean. I've actually had wheel trades in the past that lasted 6 or 7 months, so I always operate with a 10% total value stop loss. We can keep going with this and repeating steps as we go, but if the overall trade ever violates that 10% total value stop loss, we just scrap the whole thing at whatever stage we're in, we take our lumps and we move to a new target. That's the key to making this strategy work in the long run, and to be honest, that's the key to all investing. We can't eliminate risk, and there's nothing wrong with taking losses. Sometimes you try something and the markets just don't cooperate. But we can't allow things to go from bad to worse, so the Wheel of Fun always operates with a stop loss. The same sequence is also available on the call side. This would be for when markets or the individual stocks are overvalued, and we want to start at the top end. The only difference is now we're selling a cash-secured call to get things going. If it expires in the money, we'd get assigned shares, and we'd be short the stock at a higher price than shorting it right away. If it expires out of the money, we keep the premium and try again. Once we are short shares, we can sell a covered put for more premium, and again, a month later we either lose the shares or we don't, but we're getting paid to do so along the way. A lot of investors get nervous when shorting stock, but the wheel works the exact same way, and it's just as good a trade. I personally have no preference, and I've used both puts and calls many times. If we're open to using both puts and calls, since markets chop around a lot in the medium term, we can combine them. When a put wheel is done, oftentimes that does mean prices have risen, and at that point a call wheel may be more attractive. When a call wheel is complete, it may mean markets have dropped enough that we can work into some puts again. There's a lot of possibilities here, but both sides of the trades are viable options. So the only question is now, how do we choose the original stock to get these wheel trades going? Well, for that, most investors will have a short list of stocks that they like to buy, and maybe another list of stocks they like to short. If you don't have one yet, I suggest you do that. Become familiar with a handful of stocks so that you'll know when these wheel trades become available. If you're a big fan of Apple or Intel, for example, anytime they're trading in their lower boundary, you can say, well, I like the stock at X price, so you can set your cash secured put right there. If you don't like Tesla, for example, I personally have nothing against it, but it does have high short interest. So you may want to say at a certain price, at price X, I'd be comfortable shorting Tesla. So you'd set your cash secured call at that price. As long as we utilize the stop loss, we're free to get the ball rolling here. And we don't chase big premiums. We keep it small. We chip away 1% here, 2% there. And in the long run, these can be very consistent trades. So this Wheel of Fun trade is one of a dozen or more that I'll go over in the coming months, and they will all be under the umbrella of the VTS Discretionary Strategy. It's 10% of our total portfolio with a 10% stop loss. We keep it small, we keep it conservative, and hopefully we'll have a little bit of fun with this strategy. You've probably heard the old saying, if all you've got is a hammer, everything starts to look like a nail. I'll try to do my part here to introduce you to a wide variety of trade types, so you'll always have the right tool for the job. So if you've got any questions at all, I'm only an email away, so feel free to reach out and contact me. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you, so go ahead and leave those in the comment section below. See you next time.